Bismillahirrahmanirrahim. So today I'll hope that we will finish the book. Even if we don't finish the book, the course will be finished. If there is something left, I will try to cover it in a separate lecture. So we were covering the last chapter, that how is we have seen that the financial system is very bad, very unstable. So how can it be reformed? The global financial crisis made it obvious to all. So, as we said, there are two problems with finance. One is the Keynesian problem: demand can be insufficient or it can be too large. And then there is the Smithian problem: how to make sure that the investment goes to the right places. So first we look at the Keynesian problem. Last time we studied that excess demand can be handled. The usual way to handle it is by restrictive monetary policy. This is not a good way because it cuts off money supply to the whole economy. It causes a massive recession. It causes great damage to the economy. It does succeed in controlling inflation, but the cost you pay is very high. And the alternative is to restrict the flow of money into the key sectors where it is causing problems. Normally it's the FIRE sector, which is insurance, real estate, and something else. What is that? Financial sector, yes. The financial sector. These are there's the real productive sector, and then there is this financial sector which is non-productive. So when money starts flowing into that causes problems for the economy. So you want to make the money go into the real productive sector. So that has to be done by deliberate targeted control. You can't just throw money at the economy. If you do, it will cause inflation. So targeted restrictions. Now the opposite side is that if you have insufficient demand, again the standard Keynesian monetary policy encourages expansion by making money available to banks. This is what quantitative easing is. The Federal Reserve is prepared to supply money to banks. Now, in this situation, will the banks borrow and lend it forward? That is called pushing on a string. I mean, you don't control the behavior of the banks. The conventional monetary theory, which is taught in standard textbooks, is that whenever the reserve is given to the bank will automatically produce K times, the multiplier times that much as money, as credit. But that depends on whether there are enough credit-worthy projects around. So what we saw in the post-global financial crisis was that enormous amounts of money was made available to the banks, but the lending remained pretty close to zero because there were no good investment projects. And basically, that is one of the Minsky conclusions, that if the environment is bad, then even if there are good projects, the good projects depend on having a good outlook for the economy to be able to sell their output. So if the economy is in bad shape, then nobody will start projects. So that makes monetary policy non-useful, and so the Keynesian conclusion is that we should use fiscal policy, direct creation of jobs. Basically, when you have unemployment, the Keynesian theory is that you should apply fiscal policy. But Minsky says that this has problems. There are lags in implementation due to political power struggles, and not just due to political, but these are one of the things, because normally you have some party which wants to implement, other parties want to implement other things. So he says that we should prefer automatic stabilizers, things which go into operation automatically, and one of these is basically unemployment insurance. So when you have unemployment, then then when unemployment increases, automatically you start pumping money into the economy. But more important than that is the job guarantee program. Instead of just providing money to people, which can cause inflation, because basically, see, you have your MV equals PQ equation. If money increases and quantity doesn't increase, then that will cause inflation. But if you provide money to create jobs, the jobs will create product, so M increases and Q also increases, so there is no necessary inflation. So it is possible to provide jobs to everybody. This is one of the key insights, the central takeaway from modern monetary theory, which is not available in conventional macro. In conventional macro, it is said correctly that if you apply fiscal or monetary policy to stimulate the economy, you will start seeing inflation a lot before you get to full employment, and that's what the experience has been. So that's because the expansion is not targeted, it's just broad-based, pumping money into the economy. So it will go into the wrong sectors where there is no excess capacity. It will not go into the right sectors where it would stimulate. So what are the recommendations which emerge from this? Well, getting banks to make good loans requires direct oversight, targeted lending, and this is in the Princes of the Yen book, has the example of how Japan handled this. And basically, despite this, banks and shadow banks cannot and should not provide all financing. A very simple example is this microfinance bank, or even agricultural finance, or small and medium enterprise finance. Basically, all of these require specialized knowledge. The way current modern banking is set up, it is designed to be insulated from the real sector. You only deal with money. But all of the real banking requires underwriting, which requires social relationships. It requires that, basically, why did Grameen Bank succeed where everybody else failed? Because they had community knowledge, they had social relationships. The person, or the woman who did not pay back would be caused serious social loss, and they would commit suicide. And so that is actually quite a bad method, but that's how it works. It works by social pressures. And in fact, I think that the men were not given loans because they could run away, and women were much more bound to the place by the social constraints. They're much less likely to run away. So banks cannot provide all the financing, so there is an important role for government provision of finance. Actually, the best thing that is best place to finance is community banks, which have knowledge of the community, partnered with the government. The government provides them with the money to lend, and they have the local knowledge. So this is the key to expanding finance to the we keep talking about financial inclusion, but this especially when you go outside the really rich people, you can finance them without difficulty because they have assets which are good collateral. But when you want to finance, when you want to financial inclusion, when you want to finance people who don't have strong assets, then you need social capital. And that's what the Grameen Bank examples show. So that means that you need community banks, and that's how the US mortgage industry functioned well for 50 years, because you had community banks. They knew the community, they knew the houses, they knew the people, they knew the jobs, so they could do an effective job of monitoring who needs. And today, there are people, I've forgotten the name, who make a huge amount of money by making loans to farmers, because they have very strong local network and connections, and they also have these sharks who can extract money if the person is not paying. But that is not so important. What is important is local knowledge. You have to know who are the reliable people, and it is possible for banks to lend only if you have this community knowledge. And actually they have done some experiments at State Bank on how we can replace this system that we currently have, which extracts a lot of rent from the farmers. So government can provide a lot of money, but important obstacle to this is misconceptions regarding the role of government deficit in finance. Deficits don't function in the way that conventional macro tells you that they do, and taxes also don't function in the way that conventional macro says that they do. So today we are getting into real trouble because the government is making all-out effort to raise taxes, which is completely unnecessary. Taxes don't have to be raised in the way that the government wants to do it. Taxes are necessary according to MMT because they create value for money. But there are many ways you can get taxes which are not going to be extractive like what they are doing now. So there are easy ways to tax and hard ways, and currently the government is working on very hard ways because of misconceptions that we have to raise, we have this tax target and we have to meet it. There is no such requirement. There is no. So Minsky's in 1987 proposed an agenda for reform in his book called Stabilizing an Unstable Economy, and there are these 4 reforms. It says we need a big government. Basically, the private sector is subject to these automatic cycles, so the government needs to be big enough to fill in the gaps when the private sector, so the size can be calculated how big a government you need on the basis of the stabilization considerations. It has to spend to make up for the shortfall on private sector spending when the private sector is in recession, and it has to tax when the private sector is going into a boom. And basically the taxes should go into the booming sector, and that's when it's hard to, when it's not difficult to extract the tax. When you have lots of gains coming in, then and those are visible, like stock market is increasing or land prices are rising, you put a tax on that, and that solves the inflation problem, and it's also easy to collect because the money is right there in front of you. Financial reforms are needed, and market power needs to be controlled. Financial reforms, we've already discussed a lot of them, and we will discuss in greater detail. So, as Minsky said, that there are 57 varieties. 57 is just a random number. They all suffer from flaws. They lead to unemployment, they lead to inequality, and they have lack of stability. Policies can make up for these flaws, but it cannot cure them. So one of the ways to get a good variety of capitalism is to have lower amount of investment and higher amount of consumption. And this is what basically, if you give money to the poor, you will have more consumption. If you give money to the rich, you will have more investment. Now the standard model in the economist mind is that you should have more investment, that will cause growth, and growth will trickle down to the poor. But this doesn't happen. Actually what happens is that when the rich invest, they make a lot of money, and it stays with them. So so one of the ways you get higher consumption is that you maintain full employment. You make sure that everybody has a job, so the poor people are able to earn money, produce for the economy and spend. So this way everybody gets to participate in the economy. You want, in order to get avoid the problems that are created by monopolies, you want to have lots of small organizations, and you should have local organizations. And basically the government policies which are directed towards transfers, any welfare payments, BISP-like programs, they should be shifted to job creation policies. The government, the private sector cannot create enough jobs. In our context in Pakistan, the government also cannot create productive jobs. The government can hire millions of people, but it will not be able to use them effectively. So the place to go is the communities. If you empower communities and you ask them to do local jobs, many things like street cleaning and social services and policing the community, many other things, the community can take care of its own needs, and they have lots of jobs that are productive and socially valuable. This is the key, that the private sector can only do those jobs in which the private profit is there, and the social, it doesn't do jobs which have high social benefits but low private profits. And so we need to engage the communities. Minsky estimated that about 1.25% of GNP is required to give jobs to all, and there are job guarantee programs functional in Argentina and India. They have been very successful. He also estimated that we need to supplement this with universal child allowance to make sure that every child who is unable to work is also supported, and that will require another 1.25%. So about 2.5%, exactly the zakat amount, is needed in order to support the entire population, to give them productive jobs and to support those who cannot work. And the amount of product that they will be able to produce is much more than that. It was about 3 times this much. So this is a win-win proposition. The benefits of these reforms are that it is not inflationary, unlike the Keynesian program, which tries to do this by stimulating the private sector but ends up causing inflation, like we had in Pakistan, where we stimulated the economy by keeping the economy interest rates at low level for a long time, and then eventually it caused overheating. The goal, the attempt was that we should get to full employment, but it didn't happen. We didn't get to full employment, and we got to inflation a lot sooner. And then we had to increase the interest rates and use restrictive monetary policy, causing damage to the economy. So if we give jobs, we can build infrastructure which provides long-term investment to the economy. And this is again another thing which the private sector is not good at doing. The private sector doesn't make long-term investments because they are very risky and they require large amounts of financing. But if we if the government engages people in this, then it will create job skills. It will teach people how to organize, how to manage. It will create a pool of labor which has the job skills, and this will also boost private sector productivity, because the job guarantee is by design, the lowest segment. The government does not compete with the private sector. It sets a bottom level and private sector should always be able to attract people away from the lowest paying job. So this should be a fixed and uniform wage that sets the bottom rates in the labor market. One of the suggestions for reform is that we should reduce barriers to labor force participation. We should eliminate taxes which reduce the amount of money that comes into the employee. One of the suggestions that was made was that there was a payroll tax holiday, some portion of the time that the wages would be exempt from taxes. We should also allow people who are retired to work without losing benefits. In the USA, the Social Security benefits, if you take, then you cannot work for a living. So he said that reduces the productive capacity of the economy. So why do that? Also, he wants smaller bank size. This was one of the reforms that was done after the Great Depression, which was very successful. Banks were not allowed to expand beyond a certain amount, and they were all forced to be local. Bank could not operate in 2 states. Every bank had to be in exactly 1 state. All of these rules were broken. Actually, so these were the reforms suggested, but actually what happened in the US economy post-80s were all the moves were in the opposite direction. They favored bigger banks. Deregulation created shadow banks and increased their size. Bailout was given to the too big to fail banks. So concentration increased in the banks industry by quite a bit, and larger banks became much more large and powerful. So one of the Minsky reforms is to have big government which should be able to take counter-cyclical policies. As we have already discussed, we don't want Keynesian type untargeted expansionary monetary and fiscal policy. This leads to the stop-go pattern where you stimulate and then the economy goes out of control, because contrary to the Keynesian worldview, or not actually the Keynesian worldview, but the neoclassical synthesis of the Keynesian worldview, economy is stable. So if you stimulate and it gets to equilibrium, it will stay there. But actually the Minsky says that the economy is unstable. You stimulate and the stimulus will be picked up and accelerated, and it will go out of control. So now when it goes out of control, then you will put on the brakes to try to control it, and that will cause more damage to the economy. So this basic idea of the economists, that you are in equilibrium, you get to equilibrium, and if you are near equilibrium, you will be driven to equilibrium. This is exactly the opposite of the reality of capitalism. So instead of the Keynesian untargeted spending, we should have target specific sectors for job creation and do direct job creation, because the private sector incentives are not aligned. The private sector looks for jobs which will create profit for it, but maybe the profits are 30 years in the future. In education, profits tend to be at least 10 years, 15 years later. One of the major findings of Barrow was that the biggest driver of growth was government spending in public sector education 10 years ago. So basically, this was his empirical finding. So basically, we pump money into education, but the results will be seen 10 years from now, and it cannot be done on a one-on-one private basis, because individuals are risky. If you educate all of them, then you will see returns on most of them and fail on some of them. So private sector is not well equipped to handle situations like that, but public sector can. And the sectoral balance thing, which basically says that the government deficit equals the private surplus. If you take into account the foreign sector, then you have government injections plus foreign injections equals private surplus. Foreign injection is the excess of exports over imports. This is how much demand is coming for your products from the outside. So in Pakistan, we don't have injections. We have deficit in the current account, which means that our aggregate demand for imports is higher than the external world's aggregate demand for our products. So one of the reasons is that rupee is overvalued. So we need to fix that. We need to go to undervaluation, and then the government deficit has to be. So some of the leakage is taking place from aggregate demand to the external sector. So now the government has to fill that gap, and then the government deficit must be larger than that, and it has to provide a respectable margin to allow the private sector to have a surplus. So there is a minimum government surplus deficit which is compatible with the private sector expansion, because all private sector profits come from money that is injected. This is basic accounting. If there is a fixed amount of money, eliminate the foreign sector for the moment, just for conceptual clarity. So there is a certain amount of money. The households want to save money, the firms want to make profits, but nobody will get net savings and profits, because if the amount of money remains the same, then there is no way that there can be more money made. The only way that money can be made is if somebody injects money into the system, and that's what the government must do. That is why a certain amount of deficit is necessary for the economy to survive. The idea of balanced budget means that the private sector is going to be thrown to the wolves, because nobody can make profits and nobody can make savings in the net, in the aggregate. Now, the way that such economies work when you have austerity like that is that people borrow. The households borrow, and the firms borrow, and the private debt increases. And that is not a sustainable solution. So government should create infrastructure and promote long-run development. It should do direct job creation. As long as it adds to production, this will reduce the inflationary tendency. You have big government, big deficits. This can cause inflation. When you're pumping money into the economy, as we said, this can cause inflation if it's going to the wrong sectors. So you have to make sure that your spending is targeted. You should promote small businesses. And Minsky thought that you should eliminate corporate taxes because they hinder production. But you should replace this with an income tax on owners of the capital of the corporation. Basically, one of the things that has happened in the manager capitalism is that you have these third parties who are managing, and they're not responsible for the corporation. So instead, the income of we should have more direct ownership. The income of the corporation should go to people, and the people should be made more directly owners, and the taxes should be imposed on this income. So this would move away from managerial capitalism to some extent. Now, one of the things which we need to do is to reform the payment system. There were some debates that took place after the savings and loan crisis in the USA in the 1980s. One of the diagnoses which was made by the free market ideologues was that the savings and loan crisis was caused by the Federal Deposit Insurance, because the Federal Deposit Insurance made the depositors not care about how their money is handled, because even if the SNL, the savings, the thrift institutions make risky loans, the depositors don't care because they will be refunded. So according to the free marketeers, what would happen is that there's a free choice. There's lots of savings and loans. Some savings and loans are doing risky business. So then they will lose depositors because the depositors will move to the safer type. So the market discipline will make sure that the savings and loan organizations don't make risky loans. But this is completely wrong. It doesn't happen like that. The depositors don't have enough information. They only find out after the institution collapses. So this idea that market discipline will control is just ideology. It's not true. Actually, the main problem of the commercial banks was cream skimming by shadow banking. The shadow banking took the most profitable operations of commercial banking and made profits from them. They took checking accounts and used them for higher returns and risks. They created payment systems which bypassed the banks. They created credit cards. They created commercial paper, which was allowed firms to borrow from them, from the shadow banks. The banks responded to this to some extent. They offered guarantees on commercial paper and they offered various kinds of insurance. And one of the other responses was that they gave up this expensive and difficult job of underwriting and relationships banking, which is actually the key to good banking. And instead they used the shadow banking to buy insurance and get ratings. And so this was the originate to distribute theory which came into. Initially, you made loans to people that were reliable, and you had a relationship that made sure that this worked. Then you said you make loan to anybody you like, that you originate the loan, and then you just sell it to the shadow banking sector. So now you're not responsible. And this change in policy caused change in behavior. So even when you were originating loans to reliable people, when the loans were sold, the behavior of the people would also change, and when they were insured, they would also change. So one of the ideas was to go to narrow banking. Narrow banking would simply handle money. It would be 100% reserve system. It's only meant for storing money and transferring money, paying checks, handling credit cards, and basically these are actually, it would be handling debit cards. Debit cards are different from credit cards in the sense that a debit card is backed by money that exists in the bank. The credit card makes a loan from the bank and money doesn't exist and it is repaid. So that is the difference between the. So all of these functions are available to narrow banking. The narrow bankers would not make loans and therefore would not create money. So the payment systems have been developing over the period of time. The financial system, actually, you see, this is the development of the payment system is at the heart of finance, and one of the most interesting pieces of the story is how I think it was there was a commercial revolution in the Islamic civilization in the 12th century or 13th or 14th century, somewhere around there. Basically, how do you ensure international payments? So the concept of the check was developed where people could make large payments and there would be a system there to ensure that, and they could receive large payments to ensure that in the back, like today the analog would be the hundi system where you go and hand a large amount of money to some person and somewhere else in the world some other person handles the counterpart in some other currency to some other person. This is a thing which requires a lot of trust, and this is what the financial system is designed to do, that I take a check and I go to a store, the store does not know who I am, and they take my check and somebody else makes them the payment. So initially there were private bank notes which were used. The banks would issue notes and people could use them, but different banks had different levels of reliability. So these were eliminated by taxing the banks, banknotes, and that made the federal government issued note more valuable, and so basically drove them out. Today the insured deposits make sure that if you take a check on a regular bank, this is backed by a government guarantee in the USA. If the deposit money is not there, then the government will back it. So the banks are trying to develop alternative payment systems for today, and what Minsky says is that you need to protect them against the shadow banks. So some of the efforts they are making is to develop cheaper payment systems that will compete better with the shadow banking systems. Another suggestion is that when clearing takes place through the Fed, the commercial banks should be given a discount on the costs so that they are better placed than the shadow banks. The Chicago plan, which has been updated to the Iceland plan, was a plan to convert all banks to a system of narrow banks, which would be 100% reserve. But according to Minsky, this is fine, but it doesn't address the main problem, which is the capital development of the economy. That is okay, we have a safe place to put our money and to transfer money. But now if the banks are not lending, then who is going to make the loans? And that is the crucial thing. The capital should be made available to people who need to borrow. Businesses need to borrow money to operate because they incur costs early and they get revenues later. And these revenues are always risky. So the Islamic principle is that people who have money, they should invest and they should take risks of business, and then they can participate in the return. And that is how it should be managed. Here the conventional banking system takes money from people who don't want to take risks, the depositors, and it uses it to make money. It pays them back most of the time, but occasionally there is a crisis and the whole system collapses. So how do we do capital development of the economy? Narrow banking is fine in its own place, but it solves the problem, the non-problem. It fixes what is not broken. Actually, Minsky said that during the global financial crisis, the regular bank system worked perfectly. There was no runs on banks because the deposits were insured. And so that part of the problem, that is not part of the problem. The narrow banking is not the issue anymore. It was the risky shadow banks. So we need to figure out how to handle large amounts of financing for risky investments. Today we have these angel investors. They are doing these. They are taking these mega gambles on startups, and these are actually causing a lot of harm to the economy because there's a huge amount of gambling going on. There are many different ways to organize this investment in enterprises, but the current way based on profits is not working very well in the USA. So we've already discussed this slide. So what we need is an institutional design to promote stability, security, and democracy. And the way that financial system has evolved, turning back the clock is not possible. We can't go back to the 1930s reforms because the system is no longer the same. So capitalism is dynamic. Reforms of the 1930s are no longer suitable. It's not that we just put the Glass-Steagall back into place and everything will be all right. It's no longer possible. Ideologies and economic theories emerge to support capitalist interests. So one of the very serious and very difficult blockages in the path of reform is exactly standard economic theory. And the standard economic theory, which is being taught all over the world, does not even see the problems which exist because it is designed to conceal the defects of the system. It systematically made economics blind to the global financial crisis. The vast amounts of money in the hands of the money managers allows them to shape public opinion, and they do. You can explicitly find, this seems like a conspiracy theory but actually you can trace the effects. You can trace how some books are suppressed, some ideas are promoted. A lot of money is pumped into think tanks which promote Chicago ideas. You can actually, this has been done by many people, and as to who were the people, where were the think tanks, how much money was put in to promote Chicago. One of the ideas was, of course, one of the things was the buying of the Nobel Prize. That was a very important way in which opinion was shaped. They gave the Nobel Prize to every other year to a Chicago economist. So Nobel Prize accumulated in Chicago. So I have an article called Ideological Macroeconomics and Increasing Inequality, which discusses this, how ideology drives modern macroeconomics. And because capitalism benefits from a large pool of unprotected labor, so all aspects of the welfare state are under attack. And according to Minsky, the free market ideology is especially harmful in this stage of capitalism. And we are seeing the harmful effects in terms of the collapse of the whole world right now. So what Minsky suggested in the 1990s was that we should have small community development banks, increase the services in the local banks, and try to reduce mega banks. The system, as it naturally evolves, will go to mega banks. Those are the ones that are too big to fail. They will enjoy all sorts of privileges and benefits. So if we need, basically big banks serve big clients. If we want to have small controllable businesses, then we need smaller banks. They will be able to service the community needs. If we want to encourage the small and medium enterprises, we need to have banks which are specialized in this area, and these can only be done by smaller banks who have the relevant skills. So there is a proposal for a community development bank. We need to go to proactive creation of community development banks. The basically growth, one of the most powerful ideas for growth has been community-driven development. Basically, if you analyze all sorts of episodes of growth, you find that you need a lot of engines of growth, because growth requires parallel work on a lot of different fronts. So where are you going to get these engines? One possibility is the government, but the government in Pakistan, has very small capacity. They can't do a lot of jobs. So if you need thousands of drivers of growth, you're not going to find it in the government. Similarly, the private sector is not suited for this job because the profit motive doesn't work very well. In Japan and in Korea and in many other places, what they did was they created these chaibos. There was these giant corporations which were partnered with the government, and they operated like families, so they actually created communities. Once you got a job, then you were set for life. So in that situation, then you can replace the... So basically we need to turn each community into a corporation, and they look out for their own. So today the communities don't have any money to finance development. The local community banks are not there, and the banks are not well suited to using social capital. So Minsky proposes a network of community development banks which provide a full range of financial services to communities, which involves a payment system for check cashing, clearing, and debit and credit cards, secure depositories. I have called this in my proposal for creating genuine Islamic banking a Darul Amana. See, we have this Islamic institution called Amana. Amana goes back to the Prophet sallallahu alaihi wasallam. You leave your goods with somebody else as Amana, and he will give them back to you after a while. So this is your your narrow bank, your 100% reserve bank is a Darul Amana. It just keeps your money safe for you and gives it back to you when you want it. So, it can do more. You can write a check on it that so and so is holding so much goods of mine, and please deliver this to him. So that's so basically savings and transactions. But you also need so these are the functions. There's a payment system, which means that I can write a check. I can pay using my goods which are being held by some third party to some fourth party. So this is a payment system. A depositories is Darul Amana. Then you need financing for a lot of needs, like students who are going to study, they need to be financed. Housing is a huge expense and it requires finance. You need banking services, commercial banking services. This is for small businesses. So these are the functions of finance. You see, in conventional economics, we never learned. You see, we learned the theories of money, that money is X, Y, Z. I don't remember that anymore. But finance, what does finance do in an economy? According to conventional economic theory, money is a veil. It doesn't do anything, because basically it's a barter economy. I have something, I give it to you, you give me your good. The money that comes between is just a veil. It's a illusion. If you think about money, then you will go astray. So just think about the goods that are being traded. So this is going back to centuries to a barter economy. It doesn't exist. When we have money, what role does it play? So these are the functions of the financial system which we need to know in order to be able to design a better financial system. So we have payment system, deposit system, household, any consumer finance systems. Then we have small business finance. So they can borrow for basically even your rediwala in the morning, he borrows money to buy vegetables, then he takes those vegetables, sells them, he gets money, and then he pays back what he borrows. So this is the basic pattern of business needing loans. So we need the financial system should be able to provide this money. And then there is the investment banking services, which means that you want to be able to invest long term in big projects and infrastructure and things like dams, and so this requires more work. And then there's asset management and advice for households, in the sense that the households have to manage their finances over the lifetime. So they need life insurance, they need asset insurance, they need many kinds of finance. They need to know what to do with their money. And surveys show that households are not very smart about how they use their money. So people who should have invested for retirement did not do so, just because they lacked information. So this idea, which economists says that the consumers are rational and they are maximizing lifetime, this is just empirically false, and this causes massive damage. I mean, people who should have saved money and could have saved money for retirement, had they better information, end up being very badly off in retirement, because they did not take appropriate precaution, because they were not far-sighted enough. They did not maximize their lifetime utility. So this, you need asset management services. So what Minsky suggested is that you need a public-private partnership, and he suggested that we should have a bank holding company structure, we should have a narrow bank, we should have a commercial bank, we should have an investment bank, and we should have a trust bank. So these are the 4 banks which can handle all of the services. This keeps the different functions separate, which is one of the things that we wanted, because if you mix functions, that creates possibility of fraud and deception, and whenever you give people a chance, they will use it. On the other hand, you want multiple functions being available at the community level, so there are these conflicting requirements. So this solution is that you use the holding company, you have separate banks with separate functions, but you have a holding company which is able to put them all together in one place. So these proposals had some success in the policy front. Clinton passed bills authorizing creation of community banks, but they were much more restricted in scope than what Minsky wanted. So another thing that we need to do to reform is to reform the shadow banking sector. Now, pension funds are a big player in the managed money sector. Basically, the largest amount of money is flowing into pension funds, and there are people who are managing these funds. And basically, in the 1980s, when deregulation started happening, then there was lots of money that was made available, and it became possible to do things with it that was not possible before. So one of the things that came into fashion was the leveraged buyout, and there is a whole this market arose where this was a big menace. Basically, the leveraged buyout meant that you use the value of the corporation against its own self. So you said that, okay, you went to the, you said, here's $1 billion corporation. So you went to the bank, you say, I want to borrow $1 billion, and I will buy all the stocks of this bank, and the collateral is the value of the asset, value of the bank that I will acquire. So you don't need any money to borrow except for the small margin. So so there were these sharks who could go out and buy anything for you, and there was some very nice books about this which tell you much more detail. So, but basically what I want to say here is that money was used in ways that were privately profitable but socially extremely harmful. So, how can we manage these pension funds? Well, there are many ways you can do. You can do direct regulation, and that is the best way. Make sure that they don't invest in risky assets and so on. So that is the 1930s method. Also, Minsky said that you should create individual retirement accounts, which would compete with the pension funds, so that the market mechanism would also be operational. You see, there is this tension between putting if you don't, and you can see this tension in China. China had a fully public sector economy, and now they are privatizing. But private sector ideologues make too much of this. They say, oh, look, China has failed, the public sector failed, and so now they are moving towards private sector. This is not true. The public sector is still dominant. It's about 75% of the economy. But the public sector is stagnant. If you put money into a public sector managed pension fund, they will not be looking out for the best interests. So you need a balance. I mean, you don't want to let them go to take massive gambles. On the other hand, you want them to compete with each other on a limited basis to get the best possible use out of that money. So, and that requires private sector incentives. So, limited amount of competition is good, but it should not be excessive, and this requires regulation. So, how should we regulate banks? That is also very important. He says that we should regulate by functionality. What is the function being performed? We listed 4 or 5 or 6 functions that the banking sector, the finance sector performs. So currently we have different regulations for commercial banks and different or no regulation for shadow banks. This is not a good idea, because the same function performed in the shadow banking gives an advantage to the shadow banks over the commercial banks. So he said regulate the function. So if some entity, whether it's shadow or commercial, is doing deposit banking, then these are the rules that will apply to that. And if somebody entity is making mortgages, whether it's shadow banks or whether it's commercial banks, they will all be subject to the same set of rules. So all of the functions that we have gone through, they should be subject to regulations, and they should be the same across commercial and shadow banks, and that is one way to create. This will also allow competition, market competition, which is good, and it will also make sure that the risks are not too high by regulating and making sure that no risky practices take place. So what has happened over the past 30 years, since the 1980s, is that the wage share has remained flat and the profit share has increased. Growth has taken place, but all of the growth returns has gone to the financial sector. So this has led to a lot of increase in household debt, and this household debt was ultimately unsustainable. That created the collapse in the global financial crisis. And this also creates increasing inequality. When you have recovery from the GFC has taken place, the returns have all gone to the top 1%. And so a lot of studies show that there has been increasing inequality. And the basic cause of this increasing inequality is the non-productive finance, insurance, real estate sector. Basically, in this sector you can make more money than you can make in real production. So the economy the productivity in the economy has stagnated and people are worrying why has the economy stopped growing. That's because all of the growth is taking place in finance and none of the growth. When it becomes more profitable to invest in stock market than it is to invest in building factories, then basically factories will not get built, and that's what has been happening. The profit shares of this finance sector have been increasing hugely, and that is what the bubble was about in 2000s. So today, if we want to address the problem of capital development, which is the main problem, then the wage share is too low, profit share is too high, which decreases the aggregate demand, because the demand for consumption comes from the wage share, not from the profit share. The fire sector is too large, which increases the financial fragility and instability. And the financial sector does not invest. I mean, they have a lot of money, but they don't invest in real economy, they invest in finance. So that causes further problems. And there are these, and when the finance sector goes too large, then you get these too big to fail institutions, which have massively wrong incentives, and they are massively problematic. These need to be broken up and downsized. So to create a successful 21st century capitalism, we need to take the following steps. First, you go through the history. Early 20th century, you had paternalistic capitalism, you had welfare state, you had counter-cyclical fiscal policy, and this created profits when the economy was not doing well. You had low interest rates and interventions by the Federal Reserve, deposit insurance. These were all things that happened after the Great Depression. There was an investment bank, national level, the Reconstruction Finance Corporation. Today we have similarly non-functional development finance institutions in Pakistan, and these are a very crucial element of recovery. The problem always tends to be the one that people don't talk about, which is integrity. I mean, you give development finance institutions the power to create money, and as long as they invest in the nation, we will get great results. If they invest in themselves, then they will not. And so this is the problem with the development finance. Basically, the power to create money is what drives economies. When the private sector has power to create money, they invest it in the wrong places, in the real estate and the stocks, and that causes damage. If we have development finance institutions, they create money, and they put it into infrastructure, dams, roads, schools, hospitals, then the nation will develop. But if they invest it in the wrong places, then they can cause a lot of damage. So, memories of the Great Depression ensured cautious use of debt, but as prosperity continued, people became forgetful about this, and there was an evolution towards fragility, which we have discussed already. People started taking more risks, because if you estimate the risks, you find that they are low. It's very interesting. I read a paper by Mankiv about the probability of crisis, and he basically took historical data and he said, okay, we look at, there were 3 periods of prosperity and followed by 1 period of crisis, so probability is 25%. So this is ridiculous because the system itself is changing, so the probabilities keep changing with time, so you can't do estimations like this. So the system was initially quite robust, but it became increasingly fragile. So when you look at all of the structural changes that have been happening, that have created insecurity. And basically 50s, 60s, 70s, USA and Europe were very prosperous. Everybody had secure jobs and access to a lot of goods. But with the coming of deregulation, financial insecurity has become widespread. You have become previously there was this division between white collar work and blue collar work, where the blue collar jobs were insecure and they were manual labor, and the white collar jobs were secure. But today all jobs are becoming insecure. Uber is an example where you have job on an as needed basis. Similarly, secretarial services, once you could get a job as a secretary and you would have a lifetime job. Now, as needed, people are called in as temps, and then when the need goes away, they are laid off. So the free market, this is something that Marx said, that basically the market, the firms seek to maximize profits, and where will they get? They get it by exploitation. They exploit the workers, they exploit the environment, they exploit natural resources, they exploit whatever they can get. They exploit the pension fund. Today in the USA, the big move is to try to privatize the pension funds, take that away and give from the public sector and give it to the private firms to lose it like they did in the global financial crisis. So, downsizing, longer work days, white collar shock, meaning turning white collar into blue collar, and reducing jobs, etc. All basically, these are all ways to exploit the laborers, to give them lesser wages and to maximize the profits for the businesses. So there are two paths to the future. One is the hostile and uncivilized fortress capitalism. So you have a small number of very rich people, and there is lots of now movies which show this future. That you have some people who set up a colony. I once went through and collected lists. So basically the public is aware. Today also we have gated communities. If you have billionaires in economy, a few of them, and you have billions of people who are poor, then they will need to build fortresses around themselves to prevent the public from gaining access and actually trying to rob and loot, because if they see so much inequality and so much injustice, there will be a natural temptation to do that. So there is this story of people who build a satellite for themselves, and the rich people are all on the satellite while all the poor people are living on the planet. And there are many such where you have a fortress economy where there are few people who live in gated communities and have massively great lifestyles, and that's in fact one of also the drivers of environmental collapse. That let the earth go to pot, the rich can build their own environment or colonies on Mars, on Moon, and they can survive, and they can have their own air and own water and so on. They can have their own solution while the general public starves. So this is one way to go, or the other way is shared prosperity. The danger is that if you go for that, the people will only take so much, and there can be rebellions like there has been the French Revolution in the past for similar reasons, and there have been many revolutions throughout. So if you put too much pressure on the people, they might actually rebel. So in the USA, they have chosen the low wage option, low wage, high profits and high inequality and gated communities option. So they are falling behind. Their public infrastructure is going into great decline and disrepair. They don't supply cheap and universal healthcare and education. The retirement system is not working well. Healthcare system doesn't work well. There has been destruction of communities. People are living lonely lives. There was a minister for loneliness appointed in the UK recently. Families break down because of the stress of having two jobs needed to support the family. All of these things are happening at a lower pace in our country also. And if we don't understand what is happening, if we don't understand the dynamics of the big system, we will not be able to counteract them. So the market ideology that just let everybody do whatever they want, this is the key driver of the change. Big government is needed to stabilize an unstable economy. We need to prioritize real production. Investment should go into the real sector instead of investment. And there are many ways to achieve this if you understand that this is a priority. Investment needs to be directed, regulated towards the future of the economy. If you have too low investment, then you have too low aggregate demand and you have unemployment. And this leads to low profits, and this leads to collapse of the financial sector and the debt deflation problem. So the contemporary macro, what is being taught in current, because actually after the global financial crisis, there was a comeback of Keynesian economics. Keynesian economics had been discarded, but after that, it has started to receive much more respect. So from that point of view, which is Krugman, for example, is a so-called Keynesian. So their view is that these things don't happen naturally; they are driven by exogenous factors. So as long as we do government intervention, as long as we do Keynesian fiscal policy and monetary policy, we can smooth out the recessions. So according to the contemporary consensus, which is what IMF, World Bank, mainstream economists are all saying, is that what we need is deregulation, downsizing government, tax cuts, and making markets more flexible so they can respond quickly to shocks like the unexpected black swan events that happened in 2007. But that's not really true. What we need to do is to look at what this happens from the ostrich mode analysis, where you do theory in isolation without looking at ground realities. All forest, no trees. If you look at the trees, then you see that fragility is increasing, and you can take steps to counteract it. Current policy is in ostrich mode. The people don't know. They have these general ideologies that, okay, if we increase the money supply, the prices will increase. How? You need to have the nuts and bolts. You need to have how do we increase money? So exactly where does this money go? And then what happens to the money when it goes there? This is exactly the nuts and bolts, the trees level description. If you have this general theory, it's no good. Yes, if the money flows into the wrong sectors, it can cause inflation. If it flows into the right sectors, it can cause good things to happen. So you have to control those flows. So that requires much more detailed knowledge of the economy than current macroeconomic theory has. Now, Minsky is fundamentally pessimistic in the sense that the capitalist economy says that stability is destabilizing, but he thinks that he's optimistic that good policy options can be found. Myself, I don't think that good policy option exists within capitalism. You need to reform people. You need to work on people. You need to work on their hearts and souls. There was this very interesting Islamic Bank example that I failed to find, which I would have liked to study. That was a community bank, and it had extremely good performance, and it could serve as a good model for the future. All right, so I think I finished this chapter, and